Good morning. We are starting with the next chapter, chapter 6, Accounting for Companies. All of you know that company is a legal entity created through a process of law. To make it very clear, just we have finished accounting treatment in partnership firms accounts. So what is the difference between partnership firm and a company in the context of company being a legal entity? The partnership firm is not a legal entity independent from the partners. Partnership firm is mere an expression of the association of partners. Whereas company, though evolving out of association of persons, it is a separate legal entity. Company has its own identity, unlike partnership firms which do not have any separate identity. So what exactly do we mean by separate identity? The partnership firm and the partners are not different. Collectively they are called partnership firms and individually they are called partners. And these partners are collectively liable for the debts of the firm and also individually liable for the debts of the firm. A partner cannot say, look, I will not pay the debts of the firm till the other partner pays. So it is their equal responsibility. Whereas in case of a company, it has its own identity. Just like you enter into a transaction with another human being, you can enter into a transaction with a company. Company has its own debts, it owns assets, it makes profit, and it continues to exist irrespective of the fact the persons who constituted the company live, exist or not. Because this company is created through a process of law. And that process decides what is the characteristic of the company, what are the terms under which the company has been evolved, and what is the process of closing the company, which is technically known as winding up of the company. So there is a huge difference between partnership firms and companies. Historically speaking, the companies emerge when partnership firms could not meet the increasing size of the markets. After all, in a partnership firm, maximum there could be say 50 partners, and all the 50 partners will have some limited capacity to contribute capital, which means the partnership firm has got a limitation of the capital. Now compare with this the ever increasing market size. So obviously it is not possible for partnership firms to meet the capital demands in the modern era of technology where you need huge machines and all. So therefore, the people who are engaged in business and the governments thought about creating an entity which is not limited by the people who can contribute capital. Mind you, I am not saying loan, I am talking about the capital, the basic contribution of the capital. Now, to ensure that outside people who may not have any control over the management of the business, to expect such people to contribute money, capital towards the business, that would be a problem. If you go and ask A, please give me 50 crores of rupees as a capital for this company, but you will not have any hand in the management, he is not agreeable to that. Whereas in the case of partnership firm, he contributes the capital and is a right of management given to him by the act. Whereas if you want him not to have a share in the management, it's difficult. So therefore, there must be some concept that shall make that person to take the benefit of the money given to him, but no liability beyond the money that he has given to him. Such a concept evolved some 200 years back, known as limited liability concepts. Now let us see the limited liability concept in case of partnership firms. In case of partnership firms, the liability is not limited, it is unlimited. What do we mean by unlimited? Which I have explained to you earlier. The partners are liable to meet the debts, liabilities of the firm. If the firm's assets are not enough, the partners will have to contribute from the private source. So there is no limit to it. How much they have to contribute? They have to contribute till they have and till the partnership firm's debts are fully paid. This is the true characteristic of the unlimited liability. But when you come to a case of a company, limited liability would mean a member who contributes capital to the company, he shall not be asked to pay beyond the requirement of the capital which either he has already contributed or he may be asked to contribute in installments. So the day he becomes a member, his liability is known to him and it is legally determined. So what happens in case of a company is unable to pay its debts? The company has to be closed down. But the members who have contributed the capital will not give more than what they have already given or they are required to be given as per the terms of membership. This characteristic of a company, known as limited liability characteristics, necessitates creating a company independent of the persons who have come together to form a company. Definitely, there is no doubt that whether it is a sole tradership, whether it is a partnership or it is a company, there has to be some persons who want to continue with some activities or some business. Law cannot compel someone to do a business. But when they come together with the intention of making the liability limited, it has to have a different process, a process of creating the company by law. The company is an entity having its own independent identity created by the process of law. So when I am talking about this process of law, what do I mean? Here I am talking about a particular law which has the name the Indian Companies Act 2013. So companies are brought into life, created, incorporated, to use a technical term, through a process provided under the Companies Act 2013. So the first point that we need to understand when we take up a case of companies is to understand this aspect of the companies. So let us see, the companies by itself, their activities are quite wide in various terms, not only from accounting point of view, but from the management point of view, from the organization's point of view, and various aspects. But in your accounting syllabus, the syllabus that is covered for Companies Act are accounting for share capital. So we shall try to understand what do you mean by shares, what do you mean by capital, what do you mean by share capital, disclosure of this share capital in the balance sheets. How do you disclose it? Just like in partners capital account, we say A's capital account, B's capital account, and C's capital account. What is the mechanism of showing it? Here again the distinction. There is no mechanism for showing the partner's capital account in the partnership firm's balance sheet. It goes by simple principles of accounting. Whereas in case of companies, the disclosure mechanism is prescribed under the Companies Act 2013. Every company shall prepare the balance sheet according to the format prescribed, and the information to be given there should be as per the requirement provided in the Act. in the Companies Act 2013, we will also be discussing with regard to the accounting for share capital. What is accounting treatment when a company issues shares? When the company allots those shares to the shareholders, either for the cash or for consideration other than cash, that is, you raise capital for buying assets, etc. What happens in case of issue of shares? Is there an oversubscription? More people are interested to buy the shares than the number of shares the company is ready to issue to allot. And what happens to that oversubscription? What are the accounting treatment emerging in such situations? Then there are two types of issue of shares. The company may issue shares to the public, or the company can issue shares to a specific group of persons. Such decision to issue shares to a group of persons would be known as a private placement. So, how an accounting treatment in case of a private placement of shares? Stock option. Employees sometimes are given the option to take in lieu of their remuneration, along with that remuneration, the shares of the company. Here I mean stock option means option to buy the shares of the company. Now, you can't compel the employees to take shares, but they have the option, right? Issue can be at a different price, just like commodity can be sold at a different price. So, shares can be issued by the company at its face value, at a premium more than the face value, or at a discount less than the face value. Though the issue of shares at a discount has been discontinued from the Companies Act 2013. There could be forfeiture of shares. Just like you issue the shares, you cancel their shares because they have not paid the money due on that. Mind you, we have talked about limited liability. Up to the limited liability, the shareholder is supposed to pay the money as required by the company at the time of the issue of the shares. If he does not pay, company may forfeit his shares, cancel his shares. He is no more a shareholder. But the money that was taken from him will not be returned. That is known as a forfeiture of shares. And then if the company wants, he can again issue to some other person, make a new shareholder, which will be called as a reissue of shares. What are the accounting entry for this? So these are broad entries with regard to the issue of shares. Company may raise loan also. One of the very universally known method of raising loan by companies is what is known as issue of debentures. Debenture is nothing but document acceptance, acknowledgement of a loan taker. Right. Now, instead of taking a lump sum loan, you take loan from the public by issuing debentures, just like shares with their face value and certain amounts given. But what is the one fundamental difference between shares and debentures? Shares are the shareholders. They get dividends. Whereas debenture holders, they get fixed rate of interest. Fixed rate of interest. When it is fixed at the time of issue of debentures. And what is the rate of interest? A certain percentage of the capital debenture value which they would be given every year. They must be given. This interest on debentures have nothing to do with the profits. It is a charge on profit, just like any other expenditure. Dividend is an appropriation of a profit. A shareholder may get the dividend, may not get the dividend if the company decides. Whereas in case of debentures, whether the company makes a profit or a loss, they shall get their interest. Otherwise, it will become an outstanding debt from the company to the debenture holders. Now, these debentures can be issued for cash, for consideration other than cash. What are the accounting treatment for it? Since they are loan, by definition, this loan has to be returned. So, returning of these debentures are known as redemption of debentures. When you redeem the debentures, that is, you have taken the loan, when you return the loan, in case through debentures, it is known as redemption of debentures. Now, the redemption of debentures can be of the face value of debentures, can be at the premium more than the face value, can be at a discount. You pay less than that. Similarly, issue of debentures can be at the face value par, can be more than the face value, that is premium, can be less than the face value, that is discounts. Since at the time of issue of shares, listen to this point very carefully. Since at the time of issue of shares, no redemption is possible, so the share redemption has no meaning. Whereas in case of debentures, when you issue the debentures, when a company issues debentures, the terms of redemption are determined there at that time. When it will be redeemed, how it will be redeemed, what is the amount that will be redeemed, whether it will be the face value or at a premium or at a discount. You must slightly reflect here and try to remember that when you issue debentures at a premium, like shares, the premium is a profit. It's a capital profit. I am repeating, when you issue shares or debentures at a premium, which means you get money more than the face value, so that premium becomes a capital profit in the hands of the company. It is not capital, it's not loan, it is a premium. But while redeeming the debentures, if you are redeeming more than the face value, the 100 rupees debentures you are giving 125, you are redeeming at a premium, that premium is a loss. Okay? And you know on basic accounting concepts which you must have done in your 11th class, any future loss must be accounted for today. Future profit you don't account for. Concept of conservatism. You must record the loss that is likely to come in the future. So if you are redeeming debentures at a premium, which will be a loss, that loss must be accounted for at the time of issue of debentures. This situation doesn't appear in the case of shares. Now, we have talked about the issue of debentures. It can be for cash, it can be for consideration other than cash, and it can also be given as a collateral security. You don't issue, but you give debentures as a collateral security. Say for example, you have agreed to import goods or buy raw material from some party. Know that your order goes to roughly about say 10,000 crores. So the party which is likely to supply you the raw material says, look, I am not very confident about my sales. So I need some collateral security that you shall pay my dues on the raw material you purchase. Which means if the company does not pay its vendor the price of the raw materials it has purchased from the vendor, the debentures issued as a collateral security will be issued in the name of that vendor for the amount not paid by the company. Collateral security is nothing but a security against a liability. You take a loan from the bank, give a debentures as a collateral security. There are creditors who cannot be paid now. You give them debentures as a collateral security to be made as actual debentures after some time. How do we make accounting entry in such cases? Redemption of debentures can be of different types. A debenture, let us say for example, like a loan has been taken for 4 years. At the end of 4 years, you call the debenture holders, you call the creditors, return them. What is a redemption? A simple way. But there can be the other ways also, as provided under the Companies Act 2013. The company cannot redeem the debenture, all the debentures at one go. You have issued debentures worth say 1,000 crores. The redemption after 5 years, you may not have sufficient money. So what generally companies do, they redeem the debentures in installments. After 4 years, 25% will be redeemed and the next year another 25%, and the third year another 25%, and fourth year the last. So these redemption of these debentures being redeemed in an installment way will put a question. Which debenture you will redeem first? You can't discriminate between one debenture holder and another debenture holder. So in order to answer this question, redemption is known as redemption through draw lots. Among all the debenture holders for whom debentures must be redeemed, you draw a lot and you take up the 25% of debentures or 30% of debentures as you have decided. In the issue terms, you redeem those debenture holders. So, draw lots is one of the way. And the last, a very interesting aspect. These things are not possible in case of shares, case of debentures. You can redeem it at your will. But now, logically, this comes to your common sense. If I have taken loan from someone, nobody, even the lender cannot compel that I cannot return the money to him. Alright? I am paying the interest and whenever I want to repay, I will repay. Now, debentures are, let us say for example, 4 years debentures. That means company has agreed to redeem it at the end of 4 years. Right? But before that, now listen on this point carefully. Debenture is a security like a shares. Share certificate is a security. Debenture is a security. These securities after the issue by the company can be traded. Traded means can be bought and sold in a place known as a capital markets, stock markets. So there are daily transactions going on. Who has the money today, he buys securities. Who has no money or who needs money, he sells off his security and gets back his money. So in order to facilitate the liquidity with the buyers of securities and sellers of security, say stock markets are there, capital market are there. So as a student of Companies Act 2013, as a person who is going to read accounting for companies, you must be quite aware, well aware of what are stock markets and what are capital markets. Here, it is sufficient for you to understand that both the shares and debentures, generally of limited companies, of listed companies, unless the company decides not to bring it to the capital market, they are traded in capital markets. Such securities are known as listed securities. And it is to the advantage of the company to keep the securities listed, because if you enable your securities, if a company enables its securities to be traded freely in the capital market, there will be more people who will be ready to buy your shares or debentures, because they know that they need not wait till they are returned to the capital money. They can go and sell off the shares or debentures in the capital market at a price. The price can be more than the face value of debentures. Now, this aspect is known as listing securities in capital markets. Now, coming to debentures, redemption of debentures, companies have an option of redemption of debentures by trading in the capital market. How? They have issued the debentures. That debentures are bought by someone and it is being traded in the capital market. Now, company has a buyer of its own debentures, goes and buy debentures from the markets. Why it will do? Let us say, for example, the face value of a debenture is 100 rupees. For some reasons, its market value has come down to 90 rupees. And the company had agreed to redeem the debentures at 100 plus 10 rupees, 110 rupees. Market price has suddenly come to 90. Redemption time has not yet come. Company goes and buys those debentures. Say it has issued 1000 debentures. From the market, it buys 200 debentures. What happens to those 200 debentures? Company is owning its own debentures. In a way, it is a cancellation of a loan. But by that cancellation of a debentures, what it is doing? It is making a profit of roughly about 20 rupees per debenture. It is buying the debentures at 90 rupees, whereas its liability for redeeming was 110. So it is this option available for companies with regard to its listed debentures, listed securities. Companies go for listing their securities in the stock market and try to see whether they can purchase the debentures and make profits out of it. So one of the methods of redemption of debentures is purchasing from the open market and then cancellation. Of course, there could be another alternative, though which is not part of your syllabus, is what is known as a conversion method. Okay, so the debenture holder are to be redeemed, let us say for example after 4 years. At the end of 4 years, company does not have funds, or it does not want to give its liquidity, cash. So it is telling the debentures right at the beginning. At the beginning means at the time of issue of debentures. That at the time of redemption of debentures, you have the option to convert these debentures into a new debenture or convert them into shares. The debenture holder may say, look, I am not interested in any conversion, give back my money. So the company gives back the money. Company cannot compel conversion. Convertible debentures, they can be converted at the option of the debenture holder. Second, he says, okay, I am ready to convert and I don't need money immediately. Company says, I have given you debentures of 100 rupees. Instead of redeeming you 100 rupees, I am giving you debentures 100 rupees to be payable after 5 years. Plus, I am giving you 10 rupees per debenture as a discount to the new debentures. So, a debenture which was issued in 2010, redeemed at 2016 after 6 years, are further issued as new debentures from 2016 to 2022. This is one form of conversion. Or debenture holder may say that your companies are successfully running, so instead of getting a fixed rate of interest, we would like to have dividends, which can be much higher. So we convert our debentures into shares. Alright. Subject to the provisions of the Act, subject to the rules prepared by the company, subject to the terms at the time of issue of debentures, debentures can be converted into shares. Now, to ensure that this redemption process does not reduce the financial position of the company, alright, because after all shareholders have contributed the money, there are provisions in the Companies Act of creating debenture redemption reserve. And similarly, what will you reserve means taking out of the profits. So there is a mandatory provision for the companies which are issuing debentures to take away some portion from the profit, keep it separately for the purpose of redeeming debentures as and when the time comes. That funds further can be invested to make additional. Suppose you have taken away from the profit 10 crores. The 10 crores need not remain same for the next 4 years. You can reinvest somewhere, make more money. 10 crores can become 13 crores, 14 crores, 15 crores. So these are all the provisions in the Companies Act which we shall be seeing in connection with the company's accounts. So let us take first in this lesson accounting for share capital. Something which I have already discussed with you, I will just repeat it for your benefit, for your understanding. Company as defined under the Companies Act 2013 is a separate legal entity created through the process of incorporation prescribed under the Act. Incorporation is a legal term. A company is incorporated. It's just like a birth of a person. So incorporation is a process of a birth of a legal person known as a company. It is prescribed under the Act. Which Act? Companies Act 2013. The company that is incorporated can be of 3 types. Usually it was 2 types, but 2013 has added one more. The public company, where the minimum number of members, mind you, company is an association of persons. Company cannot be created by law without anyone. There must be a certain minimum number of persons. So in case of a public company, at least 7 persons come together and follow the process of incorporation provided in the Act. That company incorporated is known as a public company. And if that company issues shares with a limited liability, then it will become public limited company. A public company is a company where the company can raise its capital from the public by issue of shares. Public can be invited to contribute to the share capital, debenture capital of the company. This is known as a public limited company with a minimum number of members as 7. The same process of incorporation can be followed by persons who are coming together to form a private company, the private limited company. Here again the liability of the members is limited, but the capital is raised within the people who are known to them in a private group of people. And the maximum number of members in a private limited company is also limited by the Act, 50, 100, right? Then there can be a one-man company. Usually, a private company must have minimum 2, a public company must have minimum 7. But from 2013, one man can also go to the authorities under the Companies Act and form a company in which he is a lone member. It's known as a one-man company. Liability is limited. I've explained to you what is the liability is limited to it. Okay. So what exactly is a limited? Let me once again explain to you this with a written example. Right now, here you see carefully, we have written the word limited liability. Okay. Now here, let us say for example, shares face value are 100 rupees. You must remember the word face value. That is the value of one share. Okay. Now, a person who holds one share, he is supposed to make payment up to rupees 100. Say, let us say, for example, you buy from a company 100 shares. So, how much you are supposed to pay? 10,000. This is your liability, which is limited to 10,000. You must pay 10,000. Or as I told you, if you don't pay these 10,000 rupees, your shares may be forfeited. You pay these 10,000 as and when the company asks you to pay. But if the company asks you to pay more than 10,000 rupees, you don't have any liability to pay that money because your liability is already limited only up to the value of 10,000 rupees. In case of unlimited, it can be of a different type. There is no limit to the liability that can be. So, in very rare situations, company can be created into a liability to it. Then there is a word called members and shareholders. This is very vital for you to remember, though it may not have anything to do with account. Members are the fundamental term which constitute a company. Okay, members are those who have come together to form a company. They write to the authority under the Companies Act for the incorporation of the company. They become known as the promoters. Shareholders, on the contrary, are those persons who contribute to the share capital of the company by buying shares issued by the company. Members also buy shares of the company. So when the members buy the shares, they become shareholders also. All the shareholders are also the members of the company. If you buy the shares, automatically I become a member of the company. But there could be a theoretical situation, hypothetical situation, where a member may not have bought any shares of the company. The reverse is not possible. A shareholder has to be a member, but there is a chance of a member not being a shareholder or not having bought anything. Still, he can be a member of the company. This is usually not allowed in companies. Not allowed in the sense, when the incorporation is done, There are certain rules and regulations which the people create, companies create. In that, this is not okay. So, more or less, in 99% of the cases, you may consider members and shareholders as a synonym term. Though, legally, don't forget, there is a difference between this. In case of a public company, minimum number of members is 7 and maximum number of members is unlimited. There are two types of shares a company can issue: equity shares and preference shares. So what do you mean by equity shares? They are the fundamental members of the company. Preference shareholders are also members of the company, but they have a preference as far as the return of dividend is concerned over the equity shareholders. The preference means first the dividend to the preference shareholders is to be paid, which is generally a fixed rate of dividend. Just like in case of debentures, a fixed rate of interest. In case of preference shares, fixed rate of dividend, 10%, 15%, 20%. So such fixed rate of dividend has to be paid from the profits first to the preference shareholders, and after that, if some profit is left out, that can be distributed as dividend among the equity shareholders. Right? We talked about share capital. Now, how much a company can raise share capital? The amount the company can raise as share capital is known as authorized share capital of the company. Where is it mentioned? Mind you, authorized share capital of the company is to be determined by the persons who are forming the company. So it can be different from various companies. Whenever a company is to be formed, listen this point carefully, the persons who are coming together to form a company, they draft a document which is mandatory to prepare the document, which is known as Memorandum of Association. They also prepare Articles of Association. But what is Memorandum of Association? It is a document compulsorily to be prepared by the persons who are applying for the incorporation of the company, stating the fundamental objective of starting the company, the fundamental features of the company they wish to incorporate. What are the fundamental features of the company? The fundamental features are prescribed in the Companies Act. They have only to give information with regard to each of those features. What are the features? Name of the company. Second, the address of the company. Where is the company registered office address? Third, what is the share capital of the company? That is what we mean by authorized capital. The authorized capital is the maximum amount of the capital the company desires to raise by issue of shares. So it is not raised at one time, keeping in view the future requirements. Authorized capital is that. You can increase the authorized capital of the company, but the procedure provided under the Act is little cumbersome. So generally companies keep the authorized capital of the company at higher amounts. Right? And then you, after the capital of the company, then you talk about the liability of the members. You state very clearly the liability of the members is limited to the face value of the shares held by them and all that. Right? In the last term that they have come together, who are the association of members, who are those people, that is, who are the persons who have joined together to form a company. So they shall give that consent that we agree to form a company and accordingly. And this, whatever the date, signature. So this memorandum of association, which includes also the objects of the company, why they want to form a company, what is the business of the company, the objective, what are the purpose for which they want to raise the company. So what are the 5 important features that we have stated? To repeat, name of the company, address of the company, share capital of the company, liability of the members of the company, and the objective of the company that they are going to form. All these things are signed by all the members who are called as members of the company if the company is incorporated. They are the first members of the company, stating that they would like. This here we are interested only in the term capital, the authorized capital. Here the word capital refers only to share capital. It is not debenture capital. It is a share capital which a company can raise throughout its lifetime unless it is increased. Now suppose the company has authorized capital of, let us say for example, 10,000 crores. 10,000 crores is a huge amount. So immediately after incorporation, the company may not be requiring the entire 10,000 crores. It wants just 2,000 crores. So it issues, after the incorporation of the company, the 2,000 shares. So the amount of capital that is raised by issuing 2,000 shares becomes issued capital. Alright. So 10,000 crores is authorized capital and 2,000 crores is the issued capital. Alright. Now let us say for example, these 2,000 shares capital rupees, 2,000 crores is divided into 200 crores shares of rupees 10 each. Each share value is 10. Here is what you mean by the face value. Face value of the shares is the limited liability of the shareholder. Face value of the shares is mentioned in the memorandum of association under authorized capital. So if I say company can raise authorized capital of 10,000 crores, I would also add here divided into 1,000 crores worth shares of rupees 10 each. 1,000 into 10, 10,000 crores. Now the 10 rupees is the face value of each share. So 1,000 shares becomes 10,000. Out of that, we have issued 200 shares. Out of 1,000 shares, the company issues 200 shares after incorporation. So 200 into 10 becomes 2,000 crores is the issued share capital. Generally, company knows what is its popularity. It knows that 200 crores, 200 crore shares will be purchased by the public people. But there could be a chance that all are not subscribed. So from the issued capital, how many shares were actually bought by the investors, by the members of the public, or the people to whom shares were offered? That is known as the issued share capital and subscribed share capital and so on. So if you have issued 200 crores of shares capital and out of that only 190 crores shares are bought by the public, it is known as subscribed by the public. So the subscribed capital would be 190 crores into 10, that is 1,900 crores is a subscribed capital. Remember, issued capital can never be less than subscribed capital. You cannot subscribe more than the issued capital. So the issued capital, the subscribed capital can be maximum equal to the issued capital. Of course, it can be less if people less are subscribing to it. On the similar count, issued capital cannot be more than authorized capital. You issue 200 shares, crore shares this today, after 5 years another 200, after 5 years another 200, but any point of time, issued share capital cannot be more than the authorized share capital and the subscribed share capital cannot be more than issued share capital. Okay. Now you have issued, let us not take up the undersubscribed, let us say the entire 200 crores of shares have been fully subscribed. So you have a share capital, issued share capital worth of 2,000 crores. Now you need not ask these 2,000 crores at one single time. You may ask, but you may not ask at one time. You may ask in installments. So that portion of the face value which the company has asked the shareholders to pay is known as a called up amount. So out of 10 rupees per share, we have called 6 rupees. Alright, then it will be 6 into 200 shares, it will be 1,200 crores shall be the called up capital. You have asked shareholders to pay this much. Logically, all shareholders will have to pay this, but some of them may not have paid, so that becomes calls in arrears. You have called 1200 crores, but 100 crores has not been received. So calls in arrears will be 100 crores. Alright. How do you call this money? What do you mean by call? Now, when shares are applied for by the shareholder members of the public, those who want to invest, those who want to buy the shares, you pay some amount. You are required to pay some money by the company, which is known as application money. The application money is received, company decides to whom to allot, then decides for allotment to a particular person, asks him for the little more money out of the face value to pay as allotment money, and the balance whenever the company asks the shareholder to pay money, it is known as call money. First call, second call, and final call. That right. So lastly, we come down to a legal term known as the reserve capital. Reserve capital is not capital reserve. Capital reserve is also capital profit, which we have also seen in the case of partnership firms. We are talking about reserve capital provided under the Companies Act. Reserve capital is that portion of the authorized capital which cannot be issued by the company. It is kept separately for some particular purpose. It is a portion of the unissued share capital. It is not unissued per se, because unissued can become issued capital subsequently. But reserve capital is that, suppose say for example, which we have seen, 10,000 crores is the authorized capital. Out of that, company says 1,000 crores will be reserved for some future contingency when it wants to raise. Then the actual capital the company can immediately issue is only 9,000 crores of rupees. 1,000 crores is called as the reserve capital. I am again repeating, reserve capital is a legal term. It does not have any link with the term capital reserve. Alright. A shareholder, if he does not pay the calls made on him, that amount will be known as a calls in arrears in the books of the company. Sometimes shareholders want to pay in advance, not waiting for the company to ask for them. Such payment is known as a calls in advance. So we have understood the term face value, we have understood the term various terms of issues. We've also talked about authorized share capital, issued share capital, subscribed share capital, reserve capital in particular, calls in arrears, calls in advance. Let us see how this is shown in a balance sheet. Balance sheet of a company, this is a well-known company in India, Reliance Limited, has on 31st March 2016 its latest balance sheet. As per the Schedule 3 of the Companies Act 2013, you can see in the blue words, the terms are written very clearly. First is the shareholders' funds. This is the title. And within shareholders' fund, there could be share capital and reserves and surplus. Then there is a heading known as share application money, pending allotment. If there is any, it will be pending allotment. Then this is a liability, then non-current liabilities. This is the share capital, then non-current liabilities. What are non-current liabilities? That need not be paid in the current year within a short period of time. That is a loan, debentures, all those things. So you have long-term borrowings, deferred tax liability. I mean, this tax you have to pay this year, but you have deferred. We will pay later on. There is some dispute. And there are some provisions. The third is current liabilities. So the balance sheet in the liability side is titled as the equity and liabilities. This is equity, shareholders' funds. Then these are the liabilities that you have. Two types of liabilities, non-current liabilities and current liabilities. 2 points you must remember. The format must be exactly like this. You can't give any other information. And it must be in this order. First shareholders' funds, then non-current liabilities, then current liabilities. The details are explained to the balance sheet is known as the notes. Companies Act 2013. Schedule 3 says that any explanation details of regard to the balance sheet and profit loss account is to be given as a part of financial statement as a note. So you will see in note number 1, details are given. So let us say, for example, how this company gives a note number 1. Note number 1 is given, share capital. If you recall, where it was written, share capital as 1. This is 3,240. Last year it was 3,236. So it has increased by 4 crores of rupees. They are all in crores. So how the share capital is given, note number 1. Authorized share capital is this much. You have understood, you know what is authorized share capital. That is 5,000 crores. Okay, 5,000 crores. And then preference shares is also a part of authorized capital, 1,000 crores. This is the total authorized capital. Alright, which must be shown. Out of that, company has issued so much of equity shares of rupees 10 each, fully paid up 3,240. Last year it was 3,256. Alright, less falls by others in arrears. There is nothing falls in arrears. So the 3,240 is a share capital. If you recall, this was the amount that was in share capital. Similarly, note number 2 will say what constitute reserves and surplus. Note number 3 will talk about long-term borrowings. Incidentally, long-term borrowings, debentures will be included in these things. When we come to debentures, we will show that liability portion of it. So this is with regard to note number 1. Thank you.
Thank you for watching this video. For more videos, please subscribe our YouTube channel. Thank you.